Hi, from the Case Learning Conference for Short Sellers. I'm here with Ben Axler, the CIO and founder of Spruce Point Capital. Thank you so much for joining me.
Thank you for having me.
So now you just gave a presentation saying that you were short Mercury Systems and Tootsie Roll. What do you have against Tootsie Roll?
Tootsie Roll is a classic short. It's a product that resonated with our grandparents and not with the current generation. Candies come under fire as being unhealthy. Dentists don't recommend it. There's no analysts that cover it. We're finding sales are declining, earnings are declining, costs are going up in the business.
Why doesn't someone just acquire them, though?
It's an interesting question. They have a dual class share.
Like a Hershey's or something. Oh, they have a dual class share structure, so
exactly.
that prevents a hostile. So they don't feel like putting themselves up for sale.
The founder, not the founder, but the owner. She's getting older. She controls the shares, the B super voting shares. She's signaled no intention to sell. We think anyone that would want to buy it would be a bigger company, but all the bigger companies are under challenge right now to grow, and Tootsie Roll's declining. So a bigger food company can't really get much top-line synergy out of that business, and it's just a product that doesn't really resonate with the current generation. So we don't see any logical acquire for the business.
What about Mercury Systems?
So Mercury Systems is another sort of off-the-radar name. They make defense electronics. We started to see some strain in the financials a number of quarters ago. The chief accounting officer, treasurer, CFO all resigned ahead of the recent quarter. We saw that they were losing a big contract that was rolling off. Insiders started to sell. The stock was trading at an all-time high multiple in the sector. We put out a short case of up to 85% downside. They just missed their quarterly numbers. The stock's down about 25%. We still see another 50% downside all the way to 15.
Okay. Oh, wow. So you've been in both of those for quite some time then, I assume?
We think these are good long-term shorts. We expect them to underperform the market. We think the expectations for investors are too high. They're likely to disappoint. And right now, where we are in the cycle with rates rising, we're seeing valuations contract for lower quality businesses. So we expect valuation contraction from these companies in addition to declining financial performance.
Now that brings up a good point, because for the last, say 9 years or so, short selling has been a very, very painful. I mean, I think the title of this conference has something to do with pain, the subtitle of it. Because what we're seeing in the markets is kind of this rising tide of everything going upward, whether it's due to what we're seeing with quantitative easing or this move from active to passive. Do you see some of those trends that have kind of disintermediated that fundamental analysis that has historically been the underpinning for short selling? Do you see that reversing itself anytime soon, or do you think that short sellers themselves need to adapt to the changing times?
I think the issues you raise are definitely relevant. We do think we are starting to enter the golden age of short selling. We're now in an interest rate rising cycle. Volatility is back. That's good for short selling. We think the good old forensic financial investigative analysis that we do can provide alpha and opportunity in any market. Last year, 2017, was a tough market. We still were able to provide alpha for our investors. This year, we're having an easier time when we come to market with credible arguments as to why a company should be sold or underweighted. We're finding the market is quicker to reevaluate some of the share prices, and that dialogue with the long holders has gotten a little bit easier. So you're right, we do have to adapt, but we think good old-fashioned investigative work that provides new information in an alpha-positive manner can make money in any environment.
And I know your presentation touched upon this point, which I think is an interesting one, and that is that regulators have paid a lot less attention to companies that may be fraudulent, as well as analysts. There's less analyst coverage, Wall Street coverage, especially of the small and mid-cap companies that may be able to kind of pinpoint those areas that you think short sellers can step in, then unveil. Does that provide opportunity? And also, because of the outflows that the short selling community has experienced lately, does that, put the fraud detection services in jeopardy?
So I agree with you. There are opportunities in short selling. Regulators, in our experience, are a little bit slow to early detection of the financial fraud. So that's where we can kind of step in, share our research with the SEC, try to have a dialogue, try to warn investors in advance of financial meltdowns at some of the companies we've targeted. We also do agree that structurally, sell-side research tends to be long biased. Almost 85% of recommendations out of banks are strong buy. there's a dearth of individuals willing to say strong sell. We've consistently come out with strong sell recommendations that have provided alpha for our investors in the market. And as long as that structure, current financial structure continues, we think short sellers will have a valid and credible place in the market.
But are there enough of them?
There are.
I mean, obviously we've got a little support group going here today, but the industry has been under fire. The average short biased hedge fund returned a negative 10% last year. So, what do you do to kind of keep up investor happiness in your hedge funds?
Yeah, so I mean, I think the best thing we can do is continue to do credible research, change the perception of Wall Street that the short seller is the villain or the person to be vilified for having a sell recommendation, and try to raise the bar for research quality on the short side. I've made recently a proactive push to get out to universities to educate some of the students coming out of university into the industry to paint the picture of the short seller as a tool in their investment kit to make sure to understand what the bear case is for a particular security and not always buy into the unlimited upside. I think the Tesla investors currently now that have bought into the dream are starting to see that sometimes managers are unable to fulfill expectations and stocks do go down.
Do you have a position on Tesla?
We're not short Tesla at the moment. That's not to say we might not revisit it at some point in the future.
So you're considering it?
We're looking at opportunities all the time, and certainly for overvalued stocks that burn a lot of cash flow, that have an investor base that might not be seeing the economic realities, that certainly Tesla might fit what we look for. Which
types of companies are harder to short? Those like Tesla that have experienced a tremendous momentum in upward movement in their stock price and therefore benefiting from what you just said is overvaluation,
right.
Or those that have maybe some kind of accounting issues or fraud or things like that. Which are the harder companies to short? Which ones require a bit more patience?
The story stocks. So Tesla, has Elon Musk, who's delivered returns for investors in the past and has a cult-like following. And obviously electric cars have a big runway for growth. Story stocks are implicitly harder to short than companies where you can provide the marketplace definitive evidence of accounting fraud or management self-dealing or other aspects of misrepresentation of the business. Those will always be easier to short. Those are the ones that we focus on. We've not tended to focus on the big story stocks where Tesla 30% or 40% of the float short. It's a well-known short case. At Spruce Point, we're looking for the companies that have a 2 or 3% short interest where the market doesn't understand what the short case is or doesn't know that one exists.
Because so much about shorting is kind of when and getting in at the right point, putting your short on at the right point, as opposed to, drawing that out for years on end. It's probably easier, I guess, to pinpoint it when you see some kind of malfeasance going on at the company.
Or a first sign that the story has changed. So an example of a company we were a little bit earlier on was MGP Ingredients. They bought a whiskey distillery. They've been converting their facility from commodity alcohol to premium beverage alcohol. This past quarter was the first quarter where they really missed our analyst expectations. The stock has started to crack, and so sometimes waiting for the right opportunity, waiting for the fundamentals to catch up to the share price, that becomes a period where you really want to press your short and not back off.
Does rising interest rates make it more profitable to short?
So at the moment, we're being paid on the short rebate to short certain securities, not much, 1% or 0.5%, whereas in prior periods, there's a cost of borrowing. Obviously, the more crowded shorts, someone pitched Energis, which is 88% per year to short. We tend to stay away from those. If it's very difficult to short or secure borrow, it's a situation that we're not interested in. We love being paid to short, and we also love being right with our research and having those share prices decline. But yes, at certain periods of time, like right now, it's more beneficial to short with the rates and the rebate.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.